Hello and welcome to another edition of the Moving Iron Podcast. This podcast is proudly provided by Axon, helping dealers move more iron for almost 100 years. Find out more at axontire.com. Axon was started almost 100 years ago out of a passion for keeping agriculture moving. It's that same passion that drives them today. With a vision for a better experience for both farmer and dealer, they set out to create a better way to move more iron. When you partner with Axon, you get immediate access to a full range of products and solutions designed to meet the complex needs of today's grower. Axon carries all major brands and sizes of tires, wheels, and tracks. From custom colors and sizes to fully customized wheels, you can have the solution for virtually any problem today's farmer is trying to solve. To find more or become an Axon dealer, please visit axontire.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron, time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. Markets with Shawn Hackett. This edition of the Moving Iron Podcast is brought to you by Axon Tire, helping dealers move more iron for the past 100 years. For more information, go to axontire.com. And for the month of June, since everyone is an awesome Moving Iron Podcast listener, you get yourself a special 3% discount on a set of tires and rims if you're looking at updating your combine heading into harvest this year. So use Combine Kit as the special code word on the website, or when you're talking to your Axon rep, make sure you mention that you heard this on the Moving Iron Podcast, and you get yourself a 3% discount on a set of combine tires and rims from Alliance there. So also tractorzoom delivering insights, great place to track what's going on in the auction market, which, Shawn, if you take a look at what's going on right now, as much as I want to pretend that you're never wrong, but you're right again. I mean, here we got this hot, dry weather coming through, this flash drought that you've been talking about. Your last report that came out talked a lot about that flash drought and what that could look like. And right here in western Nebraska, kind of stretching all the way across the state of Nebraska, it's been 95 degrees, 93 degrees. It was hit 97 here out in Scottsbluff yesterday. And throw about 20 or 30 mile an hour winds on top of that. It doesn't take a whole lot to suck the moisture out of the ground. So couple all that with what we saw yesterday out of the June report that came out, the June WASDE report, ending stocks report, and what we saw there. So I guess reactions to all that and kind of what you see happening, man.
Well, in terms of the report yesterday, we've been talking about how the USDA was woefully too high on corn stocks, and the real number is closer to 1 billion. And they keep getting. They're almost there now.
Getting
almost
closer.
there.
Yeah, they're getting
closer. They're in the margin of error now. At least it's respectable.
Mm-hmm.
And we also talked about how they were woefully too high on the Brazilian corn crop.
Yeah.
And they're now getting closer. They're now in the mid 90s, and we've talked about how we felt the real numbers around 88, 90, 92, and somewhere there. So they keep making the adjustments in the right direction the way that they do it. So I'm not sure any of that was a surprise, other than it's how they operate. But it does remind everybody we just don't have any corn stocks. We don't have any soybean stocks, and we're in a drought cycle. This is something we've talked about all year long on your show all year long, that we were going to enter this drought cycle. And once we got into June, it was going to get really hot, and the drought cycle was going to, and July is going to be worse, and then before it peaks out. So now the question really becomes, how high do we need to go to factor in that we're not going to have trend line or the big crops everybody wants, and that's what we're trying to find out right now, is how far do we need to go to price all of this in. And we're still in the middle of that process, but we certainly don't think we've priced it all in yet. We still think at least new crop corn and and spring wheat certainly probably have some more adjustments upward before we fully factor in the extent of this drought when we hit the peak of it in late July.
Yep.
So,
all right. So obviously we're in the weather market now. I mean, you take a look what's going on. Everything is based around the weather. Intraday volatility is, I mean, the last 3 days, I think corn and soybeans have had like a anywhere from a 30 cent to 60 cent range, in the day. You take a look at all those factors that are playing in. This volatility is volatility is good. You want volatility to happen. You want things to move around and those kind of things. But swings like this seem to really draw some uncertainty in the marketplace that folks are trying to get their head wrapped around as to what's going on. So I guess as you take a look at this weather market that we're officially in, I'm gonna officially put ourselves in this weather market. I'm really going on a limb here, Shawn. But as you take a look at this scenario that we're stepping into, when do you really think that the market's going to really snap one way or the other? I mean, what's that line in the sand that says, you know what, boom, this is it?
Traditionally, it's after July 4th is when the market takes a look, 2-week forecast. What are the current crop conditions? How is pollination going for corn? And what's because that's when you really reach the mission critical point where there's no turning back one way or the other. And so that's usually when the market either breaks hard. So look at last year. The market broke hard down after July 4 because it made the determination that the crop's going to be good. Now, they were incorrect about that. But they made the determination in their mind that the crop was going to be good, the weather was good enough, and they made a mistake. But that's when the market decides, should they really, really be worried, or was all the worry in June just a worry, but not an actual realized issue? Our belief, our forecast, our weather algorithm suggests when we get beyond July 4, they're going to make a determination that the crop's weather is not going to be good. The crop's not going to be what we need it to be, and they're going to need to really, really rock this market higher and price in a substandard crop. How high they have to go really depends on how the nature of the July drought, how broad it is, how hot it is, how dry it is, how they perceive it all. But July 4 really, Casey, is the line that the market really decides what it really wants to do. Up until then, it's a lot of back and forth, and it's this, it's that. But they always feel like the crop can still recover if the weather is good in July. So,
Gotcha. Okay. All right. Let's talk a little bit about some of what we see happening down in Brazil. So like you mentioned beforehand, they came out and said somewhere around 98 million bushels or 98 million metric tons that they saw down in Brazil. Obviously USDA is not going to stick their neck out on what the information they get internationally because you never know what you're getting. But some private estimates have come out in that 93 to 96 million metric ton range, which is significantly down, close to what you've talked about on here. And each week, those independent folks come out and they get a little bit less than they did the week before. Even Brazil's USDA version of the USDA is coming out with a little bit less every week too. So how much is that? So obviously every week the market's watching that news that comes out, but when do you think that they're really going to bake that in? And do you really think that they'll have that opportunity this year to say, you know what, it is 88 or it is 92 or whatever it is that really drives that market up?
I think the market is now pretty aware that the USDA is in la-la land and they're too high. But I really, really believe what's really going to get the market highly, highly confident is when the exports out of Brazil aren't there. Because last year they just buried exports. I mean, record-setting exports for corn, just record week after week after week as we went into July and onward. So the real kicker is going to be when you will start looking at these numbers and it's tiny compared to last year. And then the market starts calculating, oh my gosh, there's going to be, 800 million less bushels of corn available from Brazil's exports to the rest of the world. Yeah. That's almost the entire U.S. carryout.
Right.
So the way we look at it is that because of Brazil's short crop, we've used up the U.S. carryout, which means between the two countries, there absolutely is no corn. Like The U.S. has a billion bushel carryout, but we lost a billion bushels of exports or around that from Brazil, which means there's no carryout. That's the way we look at it. There's no carryout.
Right.
And once again, the way we look at this year's crop, even though we're calling for a pretty severe drought here in July, we don't need a terrible crop. If we're just in the same, let's say, low 170s like we were last year, 8 to 10 bushel below acre, even below trend, and even if we add, let's say, 3 million harvested acres that everyone is believing is going to happen at the end of the month because of the planting and the high price and all, we have a carryout of 800 million bushels, all things being equal to demand. So we don't need this devastatingly terrible crop. It just needs to be a little bit below trend. I mean, a low 170 crop isn't that bad, Casey. It's actually not too bad.
Right.
In fact, that would be a great outcome looking at the weather we're seeing. But that means 800 million bushel carryout, which is tighter than we are right now. So really, really hard to see how. And then when you look at ethanol, you know, in 2012 and 2008, we crushed ethanol demand to get demand down to the ethanol crush is at a record high because the margins are good. So we're not rationing any ethanol corn demand for. I mean, so it's you know, what do we have to do to get demand down? I guess what I'm getting at, we have to get to a price level that we lose demand, and it hasn't happened yet. The way we see it has not happened yet. So.
Yep. Okay, so let's bounce over and talk about soybeans just a minute. So yesterday's report, they gained 15 million metric ton or 15 million bushels of soybeans from someplace. I mean, kind of stirred the market up a little bit, kind of shot soybeans down for a little bit. But I mean, I guess as you look at that, I mean, what's your thoughts there?
We're less constructive on soybeans. We've been pretty clear that we think August is going to be a drought breaker. And that means the soybean crop can be largely rehabilitated. Not perfectly, but largely rehabilitated. They had a huge crop in South America and Brazil.
Right.
Remember, they grow the South America soybean crop in the first half of the growing season, which wasn't that. I mean, it was you know, they had timely rains in the soybean area. The real part of the drought that hurt the corn market, second crop corn, but the soybeans were already done. I mean, they were already being harvested. So we had a huge crop down there. And when you're at 120 million bushel carryout, I've said this before, they're not going to come in with a lower number. There's only one place to go at 120 million, up, not down. And when we run the numbers with a crop, we think the USDA's yield numbers are probably pretty close. Add an extra million harvested acres, a good August for weather, you know, we can see that number growing to about 200 million bushels. Now, of course, still very tight, but when you're going from 120 to 200, the difference in price is pretty significant. We're talking about dollars difference in the soybean price between 120 million bushel and, say, a 200 million bushel. It's instead of being a $15, $16 market, it's a $12 to $13 market. Now, still very high price, by the way, but a big knockdown. So we're really feeling that soybeans will ride the coattails of corn. They'll ride the coattails of spring wheat. But we don't see the justification for soybeans to go higher like we do on corn and spring wheat. We think it's a follower market, and we'd be really worried about a much more protracted break in August for those reasons. Whereas in the corn market, they didn't have the crop down in South America they needed. We don't have any corn stocks here. And so, and actually our carryouts are going to go down the way we see it. So it's a tale of two different markets. Soybeans led, as you know, since, you know, primarily led from the August lows of last year into January. But we think the story really started since April, mid-April. The corn market's been outperforming the soybean market. We think that trend will continue into the blow off top here we see in late July.
Right on. The wheat market, they also had the report come out yesterday, talked about wheat, what we saw happening there. Pretty much across the board, they had they raised kind of expectations of wheat. Kansas was up 4 bushels up to 52 bushels per acre. Nebraska was up 4 bushels up to 51 per acre. Colorado, was up 5. Texas was up 2. So they have a pretty. Really, when it comes down to it, wheat had a fairly bearish report. But they're also talking about that in May, from May, there's a 3 billion bushels below the average, per the report trade estimate. So at 26 million bushels. So I guess when you look at the wheat market with all the stresses that we've seen out there, it's starting to creep into Kansas. I think this first week of June is typically when that Oklahoma-Kansas border really starts to fire up with wheat harvest. What's your thoughts there, and what do you expect to see out of Kansas as we move forward?
We think this is the high number for the year on winter wheat. Okay. We think this is the high number for the year. Like in August of last year was the high number for corn, and they had to work their way back down. We think they'll start working their way back down as more harvest comes in, and they really get the true assessment of what's going on with winter wheat. And so winter wheat seasonally likes to bottom here in late June, typical harvest pressure. So we're getting pretty close that the market's going to get ready to rally here, Casey. And if the corn market really gets going because of the substitution demand for winter wheat on feed and all that sort of thing, we see a pretty good chance for a really good, solid, strong seasonal winter wheat rally from, let's say, late June into late July to rile it to run behind the corn market's rally. The other thing that we've been noticing is that the estimates in Russia, even though thus far everyone has said that the winter kill event in the U.S. is not showing up, in Russia it's showing up way worse than everyone thought. In fact, I think we're looking at the estimate. I think I saw this yesterday, the day before, that we're looking at one of the worst estimates for winter kill in Russia, in like 25, 30 years. So those estimates are coming down fast on winter wheat because of what's now becoming a clear major damage from the winter kill events that they had over there. And so, that's that's a huge variable in pricing our U.S. winter wheat price. So while everyone's focused on, at least for now, that we have these, the crop somehow made it through it all, Russia, the numbers are getting worse. And so we're pretty constructive on winter wheat. And so we think a combination of that reality with the reality that we think the U.S. numbers are going to start coming down, along with the corn market really taking off here, suggests that we would be looking, to carve out a low here over the next couple of weeks here in winter wheat, if we haven't already done so. So if I'm a cash buyer of winter wheat, if I'm somebody that buys that kind of thing, I'd sure make sure I tighten up my belt here and get something bought. I wouldn't want to get too much past late June if I'm a cash buyer of winter wheat.
Okay. All right. Lastly, let's talk about what we see happening over in the cattle complex. Cattle has, we've seen it bent up to that $28 mark, 128 down. Now we're kind of bouncing around that 115 to 117 range. There's been box beef prices continue to climb. We're in that peak grilling season. More restaurants are opening up, those kind of things. As you've talked about, that you expected to see, the cattle prices come down because of the price of inputs, corn, i.e. corn, as you look at that. As the summer continues and we kind of creep into this weather model and we start seeing the price of corn go up, especially wheat trending right along with that as feed continues to climb. What's your thoughts and concerns with the cattle marketplace?
Yeah, it's going to be really hard for the cattle market to get a rally going, if we're correct about our forecast, at least into late July. Now, after we price it all in and we come down and crash and burn into the harvest lows, a more traditional harvest low this year, then the cattle market can kind of have a pretty good rally later in the year. But it's going to be pretty tough sledding from now into, let's say, early mid-August. And of course, we continue to be plagued by the lack of capacity to bring animals through. This hacking event just once again continues to point out, how we're in adjusting, the capacity and there's just not enough capacity. The demand is strong, but we just can't move the animals through. So it will be rectified. There will be herd liquidation. There'll be, and if we're correct about what's to take place with the winter season. It's going to be a lot of light weights that will be coming up here in the fall and the winter time. There'll be a lot of deaths in the herd, and of course the fertility reproductive cycle will really get ruptured here, and which means that as we move into the spring, summer of 22, the animal feeding units are going to be way off with demand very, very strong. That sets up kind of a parabolic rise in the cattle market for that spring, summer, into the fall of 22. So, it's kind of a bad, good situation. It's not a good situation in the short run, but if you can get through this to the other side, there's going to be some very, very profitable prices, we think, in 22 for those that are around and are operating. So our view is, do what you can to survive, because the gain's going to be really, really good a year from now. So,
okay, so jump over and let's talk about the pork complex. As you look at what you see happening there, China's they still came in and bought some stuff, but it's not been as much. They're kind of maybe just tapering a little bit here. As you look at that, hogs are close to an all-time high in prices, I guess. So as you look at the hog market, thoughts there as we head into, again, some of this high-priced feed that we see coming?
The domestic demand has been unbelievable, because we've been able to absorb the loss of exports to China, because China hog prices have completely crashed. Mm-hmm. I mean, that they're at the lowest level in I mean, they're lower than they were 5 years ago. I mean, they're losing money in the pork industry over there right now. I mean, it's just totally crashed. So they're just bustling with pork. So they're not going to be buying any pork from us for a long time, the way we see it right now. So it's the question is, and at these profitable prices, we know the U.S. is, we know how to grow pork, how to grow hogs when the price is good. So I'm surprised, that the market has held up this strong. I did not think domestic demand would be able to be strong enough to overcome this loss in Chinese demand. So we've been a little early on our bearish call, and we're surprised. We thought we would be suffering some lower prices by now. So it doesn't mean it's not going to happen. It just means that we just misjudged how strong U.S. demand was going to be. But that demand is on a there's not a limit to that. And so when we do come off of this, and when the U.S. demand for grilling, and when we filled up the freezers again, and the cold storage is back to where it needs to be again, and we get back to normal demand, it could be a really, really ugly price decline, Casey. I mean, kind of a crash market, limit down kind of market. So we'd be very careful. Like I said, we've been saying this for a little while, and we've been wrong about the price going down. But as a producer, I just wouldn't be overly confident that these prices are going to stick around to the end of the year. We don't think that they will. So,
all right. Last but not least, let's talk about the oil market real quick and kind of what you see happening there. Oil had a hard time getting past that low 60 range, and yesterday I looked at West Texas and intermediate oil, and they were all the futures. The June, July, August futures were all right around that $70 mark. As you look moving forward, longer term, do you see oil creeping up there to where it's going to be one of those? It's going to really start affecting the price of fertilizer and the price of diesel and those kind of things, where the input costs going into 22 are going to be significantly higher than what we've seen in the past?
Short term, we have a hard time believing that the Middle East, i.e. Saudi Arabia, is going to allow the price to go much higher. I don't believe they want to fire up the U.S. production engine again. And even though the administration and the banks are against producing fossil fuel and they're cutting off funding, there's still plenty of money to go open up some more wells and do that sort of thing. If the price gets high enough, they can self-fund themselves. At least the big guys can. Mm-hmm. We have a hard time believing they're going to let that happen. There's a lot of spare capacity that they could turn on that will. We don't think that we don't think they will let this market go up much higher than this low 70s. And then we think there could be a good potential for a hard knockdown here. At A lot of people have bid up the market on this. The driving season is going to be big, and we're going to use up a lot of gasoline. All those are valid, by the way. But Saudi Arabia and OPEC can turn on the spigot whenever they wish and flood the market with oil. And so we're not very constructive right now. Now, with our winter forecast, though,
right,
for heating oil, for diesel, for natural gas, for propane, for those kinds of things, wow. We think the upside is enormous once we get, kind of this correction into the fall that we see coming. Once we get into that winter cycle, we could see some really, really wild prices for things like heating oil, and of course the demand for crude oil will be very strong as a result of that. So it's kind of, once again, it's kind of a bad good scenario like cattle, where we're pretty bearish over the near term, but we think there could be, there'll be a great opportunity for cash buyers to lock in some energy needs late summer into the fall. So,
right on. So there's a lot of opportunity there, it sounds like. Well, Shawn, good stuff as usual. Folks want to reach out to you and get more information about Hackett Financial and what Hackett Financial can do for their operation, or just get some information about the reports that you put out. What's the best way to do that?
Our website is Hackett, Hackett, advisors.com. They can, sign up for a sample report. They can look at some of our interviews we've done with you and other places, and to see if how we think of how we look at things might be of value to your listeners.
Right on. Well, Shawn, thanks for being on the podcast, and enjoy that nice Florida summer down there.
Well, I could tell you we're in a historic drought down here. This is the worst drought I've ever seen down here. This is the rainiest time of the year. We haven't gotten a drop of rain.
Really?
In fact, we are, if you look at the country, we are one of the driest areas in the country is Central South Florida, which is unheard of for this time of the year. So, if you like orange juice, stock up. It could be a while right for the orange juice market.
Yeah. I've been watching that weather forecast, and it's shockingly dry in areas that it shouldn't be that dry in. So it's
the evaporation index, which we talked about in our podcast this week, is some of the highest. Is here in South Florida, which is normally humid. I've never seen weather like this down here, Casey. It is. Everyone down here is going, what is this? We've never seen anything like it.
Yeah. Well, you talked about it, that there's going to be the drought cycle is going to be very expansive, and it's going to be very intense, and until we head to this fall. So, and then it gets a different kind of intense. So it's a good times for everybody coming up here over the next 6 to 9 months.
Good times. Yeah.
Right on. All right. I'm Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you'll find the latest editions of the Moving Iron Podcast. And then go over to Moving Iron LLC, and you'll find the entire library of the Moving Iron Podcast, as well as and the blog posts that I've posted out there as well. For more information about the Moving Iron Summit coming up here in Nashville, Tennessee, September 15th through the 17th, go to MovingIronLLC.com. Up in the navigation bar, you'll see Moving Iron Summit. Click that, and all the information you need for registration, hotels, agendas, speaker information, all those kind of things will be there. Shawn's going to be there. He's going to be talking about what he sees happening in 21, 22, and then moving forward as far as some of the weather models he's talked about going. So be a very timely amount of information that's going to come from Shawn, and we'll have a lot of great information there from some other really great speakers about the future of farming, what we see happening there. So with that, I am Casey Seymour with Shawn Hackett. Let's glue some iron, folks. Out. You want to have a meaningful competitive advantage to help sell more equipment. Whether you represent the sales, parts, or management department of an implement dealership, there's a surprising amount of complexity when it comes to tire, wheel, and track technology. Let Axon worry about that so you can get back to supporting your customers. Axon has leveraged years of experience to create a streamlined process that gives you a proven path to help today's grower and sell more equipment. The roots of their organization go back almost 100 years to the invention of the rubber tractor tire. Supporting agriculture is the number one driver of Axon, from product development through sales and service. To find more or become an Axon dealer, head over to axontire.com.
higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.